the dollar mean revert. Hi, it's Charlie giving you Wednesdays/Thursdays video. Hope you're very well. So I've got a chart here of the dollar index. Let's see if I can actually squeeze it up a little bit here. This is a daily time frame here of the dollar index. So since it was below my 50-day moving average back in January and then February, really since it broke out back in early February, we can see that it's been tracking above the 50-day moving average, like apart from a small move here, but that didn't really amount to anything. So it's pretty much been tracking above that 50-day moving average for much of this year. And here now, as of today, it is, as we can see, it has broken out and it's going to be closing below that 50-day moving average unless something major happened in the next few hours, since I'm recording this in the early evening. So what is mean reversion? Well, markets like to revert to their mean or their average prices, and some people use mean reversion techniques with things like trend lines. Markets like to move away from trend lines and move back to them. Other people use things like moving averages, for example. So why don't we use moving average in this example? So on the daily chart, the price has already moved back to its 50-day moving average, but there will no doubt be levels to look at on the higher time frame. So if we come to the weekly time frame here, you can see this very steep trend line that I've got in play here. My blue moving average is the 20. So all right, by next week that 20 will be coming up a little bit more. So the potential is there for the dollar to mean revert at least to its 20 on the weekly. And then if I come out to the monthly, because it has had one whopper of a move, we can see the 20 still on the monthly a long way off. Now, price doesn't have to come all the way down to that. It could come down a little bit and just meander around for a couple of candles, and before you know it, that 20's catching right up with price there. So as far as mean reversion is concerned, then it's possible that this is the beginning of a larger mean reversion for the dollar. But of course we have to be very cautious with this sort of thing, because obviously the overall dollar strength that we've still got in play, and the fundamental backdrop. Now, what would it take for the dollar to mean revert further? So if we go back to that weekly chart, perhaps for now, what would it take for too zoomed out now, for it to revert further? From a technical perspective, obviously we've got technical breaks of things like this trend line. From a fundamental perspective, we've got a lot of central bank action coming up over the coming week. We've got ECB tomorrow, we've got the RBA, so Australia Central Bank, next Tuesday, and then the big one is FOMC next Wednesday, and there's more after that. So, and we've got in the middle of all of that, we've got the Bank of Japan, Bank of Japan as well. So, we've already heard, there was an article in the Wall Street Journal just last Friday from a journalist who is in with the Fed, and the Fed do tend to use him as a springboard or a launching pad for getting some rhetoric out to the masses via the WSJ. So, and he wrote an article last Friday talking about how just giving a slightly tempered view on the Fed coming up next week. So was that a sign that the Fed were wanting to just take the some of the heat out of the sales of the dollar? Bearing in mind a very strong dollar does affect the US in a negative way as well. It hurts exports, of course. Although what it should do as well for the US, more so than maybe other countries, is help to bring inflation down with a stronger currency. But nevertheless, their currency has got very strong. So could a slightly tempered view that the Federal Reserve is still going to be hiking interest rates, likely the market's still pricing in, I believe, a 75 basis point hike. But could we see a slightly tempered view next week? And if that's the case, then we could see, some more dollar selling. And as I've already said, markets do like to revert to their average prices or mean revert, and so you can use whatever techniques you want. You can use regression channels, you can use trend lines, you can use moving averages, whatever you want to use. But certainly it's food for thought. We've just had the Bank of Canada today, and they've just softened their tone today. The RBA had already softened their tone a little bit last month, and yet we've got ECB tomorrow. It'll be interesting to see if this is a coordinated response from the central banks, and there are consequences that if they all start to soften their tone a little bit, there could well be consequences to that. So we could actually see the euro pull back a little bit in the short term here if the ECB do anything outside of having that previously very hawkish rhetoric. So why would they start backing off? Well, the economies are all looking like they're heading towards some form of downturn / recession at some point over the next 12 months. And so, of course, the central bankers are looking at all that. Anyway, that's all the fundamental stuff behind this. So the question posed today was about mean reversion. We're already starting to see the dollar pull back or mean revert, and looking through the weekly charts, the monthly charts, and back to the daily charts, there still is scope for the dollar to retrace just a little bit more yet. Some food for thought there today. I shall leave you to it. Back with most likely some mindset stuff on Saturday.